Alrighty then. We're live. We are live. It's 3 o'clock right now, and in this 3 p.m. live stream, we're going to be talking about how we got a deal. Let me show it real quick. How we got. See if I can put this over the thing. Okay. Anyway, how we got a seller finance deal with only 5% down and 0% interest. So we're going to go and talk about this today, how we structured this deal, how we got it, and how we actually went it, negotiated with the seller, as well as the back end setting up the loan in terms of and setting and closing, things like that with the title company. So all that good stuff. And that's what we're going to be talking about today. Probably going to be here for about 15 to 20 minutes. If we have any questions at the end or anything like that, then we'll answer those. But yeah, it's actually, really, it's not that complicated. It's pretty straightforward all around. And so, just like anything, guys, the biggest takeaway from this is just taking action and sending out these kind of proposals, just seeing what works, because, there's a lot of different ways to structure deals. You can do all cash, you can do hard money. But sometimes, like on this deal that we're doing, it didn't make sense. We offered them a cash offer and it was too low. And so, for them to get the price that they wanted, they needed more money. And so the only way that we could provide that was through terms with seller financing. And so we sent them an offer for the price they wanted on our terms, and they thought that was great. And so now we're going to be doing this deal that's going to be actually probably better than a cash deal for us. So let me break it down for you guys, and we're going to go through A to Z, how we got this deal, how we structured the loan terms, and then, how we're actually going to go about paying for that and setting it up with closing with the title company and things like that, and going through the whole process, and then, how we're going to go forward with paying that and so on and so forth. Because, I think seller financing and these different deals like sub-2 seller finances can be complicated and just like confusing. And like with anything, when you don't understand it, when you haven't done it, it's inherently, complicated and stuff like that. But, when you start doing something, you really learn how to do it when you actually have to do it. And so that's how we got to this point. So here's the deal we got going on, guys. So we haven't closed this deal. We should close probably this week or next week. But this is so we found this, a wholesaler brought us this lead, okay, for this house. All right. And it's a good house. It just needs some work. It's vacant. Owners had it for a while. They don't want it anymore. Wholesaler brought the lead. They brought it to us. We took a look at it, went over there, checked it out. We like the house. It's in a good spot. It's next to some other flips we're doing. And we evaluate it. It's probably a 150 to 170 ARV house, right? That's all fixed up. We probably buy it, keep it as a rental. Okay, rents there probably $1,400 a month, right? So what we do is we go and check it out and be like, hey, we can buy this house for the wholesaler's asking, I think, 100K, right? That's the ask. I think he's got it locked up for 90. He wants to get 100, right? So we go take a look and we're like, hey, dude, we can pay 70 for this house. That's what it's worth. All right, we'll pay 70, right? So that's 30,000 less than the wholesaler wanted to get. So we throw 70 at them, like, hey, take it or leave it. This is what we can afford. This is where our numbers make sense at. We have to do, probably 50,000 in rehab to the place to get it, in good shape. So that would, bring our cost up to 130. If the house is worth 170, then, we'll make a good $40,000 profit before loan fees and everything else, right? Okay. So, so we send them that offer. Okay. A few days go by, week goes by. Well, I'm sure the wholesaler went and shopped it around to some other buyers and things like that. Well, nobody wanted to pay 100 for this house. Because the numbers just don't work, right? Like everyone's going to have to put 50,000 in rehab. Nobody wants to make, you have 20 grand goes to gross profit after hard money and everything. You're probably looking at, maybe 10,000 or 5,000 by the time you sold the house, you're underwater, right? So nobody's going to do that deal. So he comes back to us and he's like, hey, we can't, and we had told him like, hey, we can pay more if you have, if we could do seller finance. And essentially what that is just, there's seller finance it's hard to nail down because there's so many different ways to do it. There's no real like terms or parameters or anything. It's literally just like what you and the seller can negotiate, what you guys are both okay with doing, right? And so, in this case, right, the property does need work, so we're going to have to either come out of pocket or get a second loan for the 50 grand that we need to renovate this house, right? So, a lot of situations, ideally, like maybe a house is in really good shape already. It's turnkey. The cleanest way to do it is just like, hey, you negotiate where the loan terms are such that the cash flow makes sense, and you can just put in a tenant with no work required on the front end. That's probably the cleanest way to do it. Now, in a rehab, it's a little trickier, but still doable. So, but the seller was okay. So we go ahead and I drop a proposal. Okay, so I draw up. I propose that, hey, we'll pay $100,000 for this house. Okay, which is like 10,000 more than you even getting with the wholesaler, right? Now, granted, the wholesaler is still involved, right? He's still in the deal. We're not, going behind his back. So what we do, he wants to. This deal's not happening, right? He wants to get it done. He wants to get some kind of wholesale fee, any kind at this point. Like most wholesalers, they want if a deal's locked up too high, right? Like they'll take any money, to just get something from the lead and stuff like that, because they know it's a dead lead, right? The seller doesn't want to come down. They can't find any buyers. They either going to get something or they're going to abandon it because the numbers don't work at any price, and then they got to walk away. So what we negotiate with the seller. So here's what we break down. So I propose. I'm like, hey, because the biggest thing for me is long term. We want as long term debt as possible. Like ideally as a buyer, you want longest term possible and no interest if possible, right? That's your two, and as little money down as possible. These are what you need to strive for. You just, your baseline should be no money down, zero interest, and then longest term possible, 30, 40-year terms, right? Like as long as you can, because you want to have as little money out of your pocket. You want your payment as low as possible, and you want to pay your interest as little interest as possible. Those should be your goals, right? And the seller wants the opposite. They want the most money down, highest interest, shortest term, right? But there's somewhere you'll meet in the middle because the cash flow has to make sense. So like in this deal, we need the payment to be low enough to where we can pay the principal on that. And then we also need to pay, taxes and insurance because we're going to hold this long term. And then we also need to be able to pay a payment on, a $50,000 secondary term loan, right? That's money's going to cost money. So what we do is I structure a deal where we'll pay them 100 grand for the property, right? We're going to put $10,000 down. Okay. But what we're going to do is we're going to give them $5,000 up front. Okay, is a down payment, and then we're going to give them another $5,000 after 6 months. Okay, so we should be able to comfortably renovate this property within 6 months, no doubt in my mind, right? It'll probably take us like 2 or 3 months. It's not a very big property. There's not a lot that like from a complication standpoint, it's very simple. So it's going to be pretty straightforward. I know we can get that done in 2 or 3 months, no problem. 6 months, plenty of time. After 6 months. We pay the $5,000. Now, month 7, regular payments start until the end of the term. So what we do is we do a 20-year loan term. Okay, that's the amortization of the loan, 20 years. And then the term of the loan is 10 years. Okay, and with a balloon payment at year 10. All right, so we're going to pay for this loan. We're going to borrow $90,000, right? Or the seller is going to have a loan against the house for $90,000, and then we're going to make the $5,000 payment. And then another $5,000 down at month 6, and then we're going to pay $375 a month every month for the next 10 years. Okay, and then we did no interest, right? I didn't even say interest. Don't even, if you have a seller, like I would not even bring up interest into the equation. I would just say, what payment are you going to make? Because at the end of the day, that's what they're concerned about is the payment. So I just said, hey, we'll do 20-year term or 20-year AM, 10-year term, and we're going to pay you $375 a month. So. And all 375 is just $90,000 divided by 20 years, right? So if you type in your calculator 90 grand and you divide that by 240, which is the months in 240 months, and there's 240 months in 20 years, right? That's just $375. So that's 0% interest. Now, keep in mind with that, we are overpaying for this property by about $30,000. Okay. So, and they know that, right? Like they're not getting other offers. Okay. So they're not, so like the seller's cool with not making any interest because she's making 30,000 more dollars than she would if she was to sell it cash. Does that make sense? So, so that is what's going on, right? Like we're overpaying by 30 grand, but we're getting terms with 0% interest. So every single month, that 375 is going straight to principal. So every single year, so 375 times 12, so 375 times 12 is $4,500. So we're adding $4,500 to our net worth every single year. So at year 10, we'll have 4,500 times 10. So we'll only have a principal of, when that loan comes due and we have to pay that balloon, we're only going to have to refinance up to $45,000, right? So we know that in 10 years, regardless of where the economy is, I can pretty much guarantee you that rents will rise significantly in 10 years, and the property will be worth well over what we paid for it, but definitely over $45,000, right? So I know in 10 years we'll be able to refinance that, and if any point in between there, we can refinance that as well, right? Like you can go and pay off, unless you have some kind of prepayment penalty, which I doubt you would ever have in a seller finance situation. You can go and refinance a loan at any time. You go to another bank, they give you a loan, you pay off the old loan, and then you've got a better situation, right? So, so we're going to be putting, that 375 to principal every single month. And we're only, when we start the deal, when we get it, we're only $5,000 out of pocket, right? Like if I was to go to, a local bank or something like that, they're going to, require right now, especially, minimum $20,000 or 20% out of pocket. Sometimes right now, even, 25% out of pocket. And even most hard money lenders, like you're going to be putting down at least, 15 to 20%. And that's for very short term, like bad, not bad loans, but they're just short term loans with high interest rates and things like that. So this is barely any money down, $5,000, 5% upfront, and then no interest, right? So it's a pretty good deal. And with that, so we worked it out so say let's look at the economics on this deal. So we've got a payment of $375. Okay. The interest, the insurance is probably going to be, $1,000 a month. So let's just go ahead and we'll put this on the screen capture real quick. So that you guys can see what I'm doing here. Just getting out some tabs, but I got a couple calculators, so we're gonna present the screen. Okay, so here we go. So we've got these calculators. So let's run these numbers. So our payment $375. Now insurance. It's probably going to be $1,000 a year on this property. Okay, so we're going to divide that by 12. This gives us $83. So plus $83. Taxes on this property are about $1,500 a year. So $1,500 divided by 12, 125. So add 125. Okay, so there's our payment for that portion. Now we're going to borrow. We may come out of pocket, but let's just say we borrowed the full $50,000 in a term loan from the bank for this deal, right? So we can I know that most banks are going to be about 20-year terms on that. So, and right now the going rate for interest is going to be about, 6.75%. So let me pull up a mortgage calculator and we will see. So if we go to a mortgage calculator, we're going to put in there 50,000 50,000, 20-year fixed at 6.75. All right, 6.75. So now this is pretty, this is going to be pretty, this is probably what you'll get. You're right now at this moment in time, October 25th. Now rates are I think they're gonna go up in about a week, but this is what we would get right now. So 380. So plus 380, and then we usually take out of pocket. This is like what we gotta pay. Like every single month, this has to be paid. This is so the government doesn't take it, burns down, you get paid. And then everyone's getting paid, right? So that you're at $963 a month in your total commitment. Now, I know this property, it's going to be a 3-bed, 1 or 2 bed house, decent sized house. This will rent for, $1,400 all day long, right? So $1,400 minus 963 is $437 a month. All right, that you're going to be able to put in your pocket. Okay, now we typically take for all of our properties, we're taking about 10% of the gross rents as maintenance, capex, all that stuff. Taking about 10% of the gross, and just this is for underwriting purposes. We are putting these into accounts and stuff to have, but like let's just say 10%. So minus 140, 10% of $1,400, $297. A month. So that's pretty good, right? Like $300 a month, is you're going to be taking and putting right in your pocket. Okay, that's after everything, maintenance, all the whole 9 yards, right? So and we only had to put 5% down for this deal, right? We only have to put $5,000 down. So 297 divided by it'd be so 297 times 10 or times 12. That's what you would make in a year. Every single month after the first year. Okay, this is just year one. On our $5,000 investment, so we divide that by $5,000. That's a 71% cash on cash return, and it gets even better. So year one, you're going to be paying down 375 times 6, which is the because you have your 6-month period of no payments. So times 6. So 2,250. So we're going to go back. So plus 2,250 equals over 5,000. So 5,814 divided by 5,000. And what I did there is that's just simply the principal pay down. So, one of the ways you make money in real estate is through principal pay down. And that's, paying down your mortgage, because every payment is adding to your net worth. Because like, say I want to go, in year 5, right? So year 5, 375 times 12, which is 12 months in a year, times 5, $22,500, right? So at year 5, I could probably go to the bank and borrow 20 extra grand against this property, because that's what I've paid down, right? So that is money that we can access later down the road. So that's what so that's where I'm getting that principal pay down. That is adding to your net worth and to the equity that you can borrow from. So on that initial $5,000 down, so in the first year, we are making a 116% cash on cash return, all right, or total return. And it gets better than that. But cash on cash, we're making a 70% cash on cash return, guys. This is real. This is a real deal that we're doing right now, that we will get done. And we're going to make, a very high return on the money we're putting in. And then not only that, but that whole, that 100,000, plus the 50,000 of work we put into it, gives you can get your cost basis. So we're going to be able to depreciate $150,000 divided by, we're going to be able to depreciate that. So you can take that number for residential property times 20 or divided by 27.5 years. So every single year we can deduct $5,454 in depreciation from our taxes. So let's just say 375 times 12. That's only $4,500 of profit on this deal. We can actually, so we're going to basically pay no taxes on all the income, right? Because we're actually going to be able to take extra depreciation, like almost $1,000 in depreciation on top of wiping out this income. So this is tax free, guys. So this is one of the things that's cool about real estate is that this is how real estate investors like Donald Trump, Grant Cardone, stuff like that, they don't pay any taxes, guys, because all this money is tax free through this magical thing in the tax code called depreciation. All right, and this, you can take that income, that extra depreciation, so you have that minus 5454 is an extra $954 that you can apply towards your other incomes, your other profits, right? And then you can make that disappear too. So this is really slick. All right, this is really cool. From $5,000, we're gonna make well over that in the first year. All right. So this is really great, and then we'll have that property forever, right? Like, it's going to be a good rental. It's probably not going to have 10% maintenance because we just redid everything because we invested that $50,000. So really, it's probably going to make us $450 a month, and not really have any problems for a good while because we just fixed everything. So so we're probably going to make more than even that estimate just because we're totally redoing the property. It's brand new practically, and it's ready to go. Okay, so now let's go on to how. So this is the deal, right? This is a real deal that we're doing right now. I sent an offer to another seller, the same exact loan terms, and she's just she's probably going to counter and want some interest or something, but whatever, we can work with her. So these deals are happening right now, and guys, one thing that is happening is interest rates are rising extremely rapidly right now, and as a result, the value of homes is going to come down. And I'm not worried about that. I've got rental properties. I've got 9 units. We own, me and my partner collectively with the houses we're flipping, we own like 15 houses right now. But I'm not worried about them because, there's only 2 times that it really matters, right? When you buy and when you sell, right? And it also can matter if you're, wanting to refinance and stuff, but you don't have to do those things, right? So, it only really matters when you buy and when you sell. So I'm not planning on selling any of the stuff that I have, in the next 10 years. So it doesn't matter. I don't care about the interest rates. Like, I don't care if the value of my stuff goes down because the rents are going to actually probably go up because, there's the home prices are becoming less affordable because interest rates are rising, payments are going up. And so in this rising interest rate environment, your mortgage payments going up, and the cost of materials is still increasing, cost of labor is still increasing, inflation is still increasing. So it's getting harder to flip, right? But you can still burr and things like that. It's getting harder to burr because of interest rates. So what you can do to avoid all this is seller finance, right? Because the seller is not constrained by what they can borrow money from the Fed at. They're not limited by any of these things. You can negotiate whatever terms they like. So like this loan that we got with the seller is essentially like, let's play with the numbers here. So we got a $90,000 to get a $375 payment at a 20-year term. It would be the same as us. So 90,000 at 0, 375, right? If we bring up another mortgage calculator, this is essentially what we got it for. I think we worked it out the other day. So I think it works out to be about 70,000 at about 5%. Yeah, so that's exactly what it works out. So the same thing, right? So 90,000 over 20 years on 0% is 375. 70,000 on 5% is 376. So this is a 30-year fix. Let's go down a little bit more. Actually, okay, so this is a bit higher. So it's actually probably more like 70,000 at 2.5. Yeah, so it's pretty close. So 2.6. Yeah, there we go. So it's really like this boils down to if we got a $70,000 loan at a 2.6% interest payment, which is like phenomenal, right? Like we were going to buy this place. So we just say we got it for this. So say we got it for like 70 grand, like the price we wanted. We're able to put $5,000 down, right? 3.5. Yeah, so this is basically the same. So our terms, 90,000 at 0 is essentially the same as getting 65,000 at 3.5, which is killer, right? This is an insane deal, right? Like, you're going to go to the bank right now and you're going to be at 7%, 6.75, 7%, 7.25, something like that. So this is a killer deal, right? Like this is like no interest, but if we were to pay interest, this is pretty much the equivalent of what it would be. So this is like we're overpaying, but we're really underpaying because to get a phenomenal loan like this doesn't exist right now. Like this is not something you can go get from anywhere else. So this is a really great deal at 90,000. So these are the kind of things you got to think about when looking at things. Like just because you can't get a house for the price you need cash, you can go and negotiate with the seller. Hey, we'll give you more money. It's just got to be over time, right? And the thing is, like, one thing that because we've tried to present people with these seller finance things before, and especially with like older people, you gotta look at it from their shoes. Like some of them are okay with a 20-year like full term, right? But like some of them are thinking they don't want to have this loan for 20 years. Like they're thinking that they might not even be around in 20 years. As morbid as it sounds, people aren't stupid, especially people that have property. Like they're realistic. So one thing you can do and this is what I thought about to try to get this offer accepted, is you put in balloons, right? So like, so it's a 20-year term. So that means that our payments are stretched out, but it's a 10-year balloon. So 10 years is plenty long enough. Because like if you go to the bank, you're only going to get a 5-year term. It'll be a 20-year AM, 5-year term, and then it typically adjusts whatever the market rates are at the end of 5 years, which is the going rate of money, right? Like that sucks. But that is like, so if you can get double that time, 10 years, most people think they're going to be around in 10 years, right? 10 years is probably the maximum, for your average individual, is the maximum time horizon that they're thinking about, right? And so they're like, okay, I can wait 10 years to get that full amount, right? And so if you put like, say you give a guy an offer for like a 30-year loan with a 10-year balloon at the end, then he's just thinking about it's a 10-year loan, right? This gives you the advantage of 30-year amortization, but he gets the advantage of getting paid at the end of 10 years. And at the end of 10 years, I don't think we've ever had a period of time where properties have not risen in value at the end of 10 years. So like worst case, you're going to be able to get a different loan, right? And most of the time in that 10-year period, there's going to be a time where interest rates are going to drop lower than when you originally bought the property, right? So it's probably going to be a better time either at the end or in between where you can refinance to better financing. So I'm comfortable with having 10-year loans. That's really great. And that's going to help your offers get accepted because people, when you hit somebody like, say somebody's 60 years old, and if you hit them with a 30-year loan term, like they're thinking like, I'm going to be 90, like, what am I going to do? Like I don't need the money then, I'm dead. Right. So these are some things you got to think about. Put yourself in the seller's shoes and think about, what they're doing. Right. So how do you actually get this done? Right. So now we negotiated with the seller, they're cool with the offer. They like it, they're good. They like you, whatever it is. How do you actually go about executing that contract? Right. Because there's a couple things in here that are tricky and we haven't fully, we've got, ways we can do the second part, but the first part is you got to go to a title company. You need to go to one that is, investor friendly, okay, and that's flexible, right? They're creative, right? There's a lot of title companies out there, or we use title companies in Missouri and the Midwest, but like some places use lawyers, things like that. Find one that's creative, that's investor friendly, because they're going to have to draft up what's called, you got a purchase and sale agreement, and then you also have what's called a deed of trust, which is essentially the mortgage, right? It's a mortgage, right? So a mortgage is simply a promissory note. Deed of trust, it's all the same thing. It's essentially saying that, Johnny Buyer agrees to pay, Susie Seller X amount of money at, in accordance with the loan terms you set up. So like in this case, we're setting up a promissory note with the seller that's going to be recorded when we close, that we owe them $90,000 that will be paid $5,000 now, $5,000 after 6 months, and then $375 a month until year 10, where we'll pay the full amount in a balloon, right? And that's all it is. It's not that complicated. It's literally just like, the terms of the loan are like, they're just like 5 bullet points, right? Like all you need is, how long, down payment, interest, payment per month, and the terms, like the term of the loan, and that's pretty much it. Like, it isn't that complicated, uh, but it's helpful if you just put some numbers on the table, and you can reverse engineer it as to what your cash flow needs to be for this deal to make sense. So that's all you got to do. You got to find a title company. You call around, call a few of them, be like, hey, have you guys ever done any deals, seller finance, or like drafted any of these things up? I would ask them if they've done anything like that. Are you guys investor friendly? So on and so forth. Ask those things. So ask that, and get that done, and then you'll find a title company that can do that. All right. So after that, your deal's done. You go to close. You pay your $5,000, and then the second thing you're gonna have to do is you've now bought the property. You got to get your insurance and stuff like that. But the next thing is to go ahead and start your renovation in this case. And what you're gonna have to do is find a like, there's a few different terms for it, but a gap lender or a renovation lender, something like that, that will do a unsecured or seller or second lien position loan to give you that $50,000 money you need to renovate the property so that you can get a tenant in there. Now, some people would do they might flip a deal like this. In this case, it doesn't really make sense as a flip, and nor do we want to flip it. We're trying to hold everything because that is where the long-term wealth is going to be built for us. Especially with great financing terms like this, why would we want to flip this thing? Because even if we did, with $100,000 loan amount and a $50,000 budget, right? Like, the property is probably worth 170, 175 at the end. So, if we were to go to sell that, we'd have to pay back the 150 in loans. Plus by the time we get done with selling the property with real estate commissions and things like that, you're basically breaking even, right? So there's no point in trying to sell it. But if you hold it as a rental, like the numbers we just worked out, you can make a lot of money over time. That's what we're going to do. So you got to go find a secondary lender. Now, there's a lot of lenders, like if you go to the Pace Morby, like the Gator lending community, you can do that. There's ways to draw funds, like from a line of credit on your house or something like that, or another investment property to acquire funds. What we're trying to do to use other people's money so that it doesn't hinder our ability to take on more projects is finding private money or even hard money that will do secondary lien financing or unsecured and give us a loan for that renovation amount, right? So, and I've talked to some people that will do this. There's guys out there that will lend you money for these things, because typically it's lower amounts, like $50,000. It sounds like a lot, and it is, but in terms of loan amounts, a $50,000 loan is very small. Okay. And so a lot of, especially if they're a big investor, or they have a lot of money, like $50,000 is not gonna it's not gonna kill them if they were, which none of our deals were ever gonna not pay people, but from their perspective, like if they lost 50 grand, it's probably not going to be the end of the world. But they're willing to do loans like this. So what a second lien is you have your first lien position. So if something were to happen, like if you stop making your payments, okay, all this means is that the lien holders, the people that have lent you money for the asset, what they'll do is, if for whatever reason the borrower was to stop making payments, that allows them to foreclose on the property. And typically with most banks or lien holders, they will try to sell the property. So when they go to sell, all the proceeds will go to the first lien first, okay? The first lien holder first until their loan is paid off. And then any remaining proceeds will go to the second lien position, okay? So the second lien is riskier because there's a lower chance there's going to be less money there to pay off that second loan. So it's a higher risk position, or an unsecured, which just means they're just giving you money with no collateralization of an asset. So it's a riskier spot. So that money might be a bit more expensive. But what you can do is you can find people that will do that, and they'll give you loans, like private money, some hard money lenders, even a local bank, if you can, negotiate or cross collateralize with another asset you have, something like that, business line of credit, you can get that money and then use that to pay for your renovations. Now, ideally, you're going to do that on a you're going to try to get that money on a longer term, like, a 20-year term loan on a second lien, right? So that, because you want to, you're going to keep this for a long time. You want the, the tenant to pay for the financing, right? So that's how you would do that deal. So that's how you would go about. And then once you've, completed your rehab, obviously you're going to need to do that. Once you put a tenant in there, this should all be done in the 6-month time period before that second down payment. You remember, you're not having to make any interest payments, any payments in the first, 6 months. So ideally, like, say you get done with the house in 3 months, right? That's a very realistic time frame for this renovation. So you've gotten 3 months to collect rent. So now you've collected. We'll go over here. Let's just say you got the project done in 3 months, and you had a tenant in there immediately, and you're making your $1,400 a month. 1,400 times 3, so $4,200, right? This is the amount you've collected, and so you can take all that money, and there's another $5,000 due, and you basically just take all the rent you've collected and you go and pay the $5,000, right? So you might have to come out a little bit, but maybe you had it for 4 months, right? So 1,400 times 4, you're ahead, right? So then you don't even have to come out of money. We're probably not going to come out of pocket at all after the first $5,000, because the tenant will pay for it. So this is how you can do really clever things. Even in, you just got to do deals, guys. Like, that's the bottom line. Like, it's just, you got to keep throwing stuff at the wall. You need a lot of leads, a lot of opportunity. Just throw offers at people. You don't need to spend all this time writing up offers until you get something to buy, right? Like, everybody's just a person. They've got different wants and desires, but like, people making it way too complicated than it really is. It's just like, hey, will this work for you? Hey, will this work for you? You just got to be in a position of bounty. There's tons of deals out there all day long. There's enough for everybody. Partner with other people, guys. Work with wholesalers. Work with other investors. Make things happen, guys. Get stuff moving, right? So that's what's going on here, guys. If you guys have any questions, comments, concerns, let me know. But basically that's how it works, right? Like, it's very, it's pretty straightforward. So we're going to keep doing this. We're going to start, like, a big portion of our strategy is going to be, we'll keep doing the regular traditional deals where we're buying stuff cash, but I think a lot of stuff is going to go to, seller finance and stuff, because, like, no investor, the numbers just won't make sense for cash deals at the prices that the sellers want. So they're going to have to get realistic, because nobody's going to offer them anything, right? They're not going to get what they want, because, but you can give them what they want with this seller financing. You can get a great deal. The seller can get a great deal. She's making almost 150% more than our cash offer over that period, right? So she's making $30,000 more than she would taking cash. And so she's very happy. And then we're very happy because this makes sense for our model. And, so everybody wins, guys. Everybody wins. This is not there's every investing and stuff like this, like, you have to make things where everyone's winning. There has to be a benefit to all parties involved for these transactions to be fun and to work, right? So this is how you do it, guys. So we've been going for about 40 minutes. I'll allow a minute for some questions if there is any. Looks like we got one person watching, but we're going to keep doing these, guys, every single Tuesday. We're going to be doing these live streams, guys. We're going to be going over a different topic, talking about the deals that we're doing, and we're just going to keep going at it, guys. So yeah. So guys, I hope you like that. If there's no questions, I'm going to go ahead and wrap it up. But guys, go ahead and like the video, like the stream, subscribe to the channel for any more content that we put out. We're putting out content every single day. Subscribe for more, guys. And with that, I'm Dan Cohan, and we will see you guys in the next video.